At some point in your adulthood, and to me, it's this year, I guess, 2023, you start thinking about what is a trust? Do I need one? And what does that even mean? So if you've ever wondered about any of the different types of trusts, estate planning, we are breaking that all down today. Welcome to Office Hours, a tax podcast by Fujikawa Associates. And we're your hosts. I'm Josh Baldovino, one of Derek's clients and a real estate investor. And this is Derek Fujikawa, who's a managing partner of Fujikawa Associates. Derek, how you doing today?
Good, thanks. How are you doing?
Good. So today we are diving into another level up of adulthood for me, which is trusts. And I'm excited to dive all into it.
We could talk about the big tax implications for the trust is more, it really isn't even a tax implication, but more when you're at the end of the trust or when you pass away. That's where all the tax and legal kind of effects of the trust happen, at least the living trust. I assume you're referring to a living trust when we're talking trusts.
To be honest, I know, again, nothing about trust.
There's lots of different kinds of trusts. There's like charitable remainder trusts. There's residence trusts. There's all kinds of ways that you can gift things to people without gifting it. So the definition of a gift is you gift it, you no longer have control of the property, right? You give it, you can't take it back.
Okay.
But there's ways you can use trusts where you can control the asset, even though it's not yours. You can control it while you're alive and then pass it when you die. So like the charitable remainder trust, that's what I was talking about. Say you wanted to give a big pile of money, or say you had all these different houses and you wanted to give this house to a charity, like your church or whatever, anything, any charity, but you don't want to give it to them now, but you need the income generated from that house to sustain yourself. You can create a charitable remainder trust, put the house in there, and you still control it. You still get the income off of it. But when you die, it goes to the charity. But the year that you put it in there, you get the current not the current market value. There's a formula you have to use to basically like the time value of money, assume your date of death or assume your life expectancy, and then reduce it by the time they get there. So you put $1 million house in there, you could take like a $500,000 charitable donation this year or whatever. I don't know the exact formula. It's a really substantial, and then you still have control of this asset. You take the income out of it. And then again, like I said, when you die, then the charity gets the asset.
Jeez.
Yeah, there's tons of trusts like that too. Or there's like ones where you can put your rent in there and gift it to your children, but you still get to live in it. There's that one's called the irrevocable living. I don't remember it.
Revocable living trust?
No, it's irrevocable. Dang it. The acronym is an ILIT, ILIT, and I can't remember what it stands for.
If you had to ballpark, how many different types of trusts are there? What would you say?
Oh man. Different.
Like over 10?
Oh yeah. The way they're structured are very similar. There's about 4 or 5 different trust structures, but what you can do with them, there's really dozens of different types of trust.
Gotcha.
Most people think of just the living trust. You always hear you have a living trust, right? And that's more for you to pass on your assets to your heirs. It doesn't really affect you during your lifetime. It's called a revocable living trust because you could put things and take things out. So it's really just a holding place for all your assets while you're alive. And then if you're married, if one of you dies, then it becomes its own separate entity holding those assets. And then it's a vehicle that you use to distribute it to your heirs or to your surviving spouse or whatever. But while you're alive, it's just a kind of a little holding place. It's disregarded for tax purposes because the tax ID for a living trust is your social security number. So everything gets recorded under your own individual return. You're supposed to put everything in there so that when you die, then it becomes its own entity. And that's when all of the benefits of it kick in.
Could you give me like the 5th grader definition of a trust? Is there a generalized definition?
Kind of what I said, it's just a vehicle to hold assets. And then you can use that trust to do different things. So like the living trust, that's a vehicle just to hold the assets until you pass away. And then you use that to administer your estate after you die. There's other types of trusts, like an irrevocable trust, where you put money or assets into that trust and now it's no longer yours. So it's its own entity at that point. Once you create the trust and fund it, you put money in it irrevocable. So you can't take it out. You can't take it away. It's there. Whoever you appointed as trustee has control of those assets and it will stay in effect until for whatever duration you assigned when you created that. So whatever that trust document says, it rules everything. You can't say, oh, I didn't mean to do that and take it out. You're stuck with whatever you set up with an irrevocable trust.
Gotcha. Okay. And then one more maybe dumb question. Do I even need a trust?
So The living trust, that's what most people ask about, is a living trust. So somewhat interchangeable when people ask that because most people are referring to a living trust. It really is for estate planning purposes. That's the biggest thing. It's not going to help you on your current taxes. It's not going to reduce or increase your taxes. You're not even going to have to file a tax return for the trust because the tax ID number, like I mentioned, the tax ID number is your social security number on a living trust. So it's really for estate planning purposes. You set it up, get all your assets in there and create it the way you want to so that when you pass away, everything gets administered the way you want it to. Because if you don't have a living trust, then your assets go into probate and the state takes control. And then they're going to distribute it the way they think it should be distributed, which if you have kids, they'll probably just go to your kids, but maybe not. Maybe they think your brother deserves something or whatever, sibling or whatever deserves something that you didn't really want to pass on to them. The other thing is probate is public. So anyone can look into your probate case and see what assets you had. Creditors get access to that. And if you have any outstanding debts, they'll definitely see that. Versus the living trust is private. It's administered by the trustee. The courts don't get involved at all, and your debts should be paid. But that's some outstanding debts. Your creditors aren't going to see that, at least immediately. They may somehow find out, but it's not public.
As I realized in my journey of adulthood of the
Yeah.
different levels, this is the next one that I've been really thinking about in the back of my mind. Like, I have 2 kids,
Yes.
a couple rental properties now, and that's something I should think about.
Definitely. Even it's everyone, not everyone, but I hear some people say the current estate tax exemption is $11.4 million. Why do I need a living trust? Nothing's going to be taxed anyways if your estate is under $11.7 million. But again, that probate issue, it's not public. You can direct where it goes. Probate also has a fee. You end up paying a percentage of your total estate to a probate referee. So you lose part of your estate that way. But the other thing too is in a few years, current law sunsets and the estate tax exemption goes back down to 5 million or 5 million indexed from then. So if it goes back down to 5 million, like especially here in Silicon Valley, if you own a couple of properties, you might be over that exemption amount or close. So, it's not unreasonable to think that you're going to be over that amount. And then you may end up owing estate taxes, which are very significant. It's like 50% of your assets over the exemption amount. So if you had $7 million and the exemption was only 5, you've got $2 million of assets over the exemption, go about $1 million in the state taxes, which is
Wow,
not an
a
insignificant
lot.
money. Yeah. But if you set up your trust right, there are things you can do to mitigate that. Currently, they allow you to transfer your exemption to your spouse. So currently you actually have about 22 million or 10 million if it goes back down to 5. But again, 10 million is a lot of money, but depending on where you live, you have stock options, you have a house or a couple of houses. It's not unreasonable to think that your estate could be over 10 million. So you can set up trusts to work around those and maybe not eliminate all the taxes, but help minimize it quite a bit. Yeah. So,
Interesting. And I feel like as you think about, again, adulthood and path to it and just
yeah.
living your life, finances is something that no one likes to talk about.
No.
It's this weird gray area.
Finance and death. No one wants to talk
But
about
death is the one that's even less talked
that.
about
Yeah.
because you don't ever ask
No.
if your grandparents pass away, which is usually what happens. And you don't ever
Mhm.
ask your parents, like, what happens with the estate.
Yeah.
You console them, and then they're left with this huge thing to deal with anytime that happens. And this is really helpful.
Yeah. And money is a funny thing too. It's a close family, and then the parents die, and all of a sudden they don't agree on what to do with the money, and it can really tear families apart. If it's not structured, then it's up to the beneficiaries to figure things out. And if they have to do it on their own and they don't agree, it can become a huge mess. Whereas if you have a trust that directs where everything goes, then it's all on paper. You can't go against it because it's all there. And even if people don't agree with it, it was the wishes of the parents or the wishes of whoever passed away. And the trustee has to follow that. They can't deviate from that unless a beneficiary could disclaim their portion if they wanted to. But essentially, the trustee has to follow the trust and distribute it the way that they say. So you can be very specific. And if you yourself know your kids aren't going to get along or, may not agree on things, you could say, this is exactly how I want it done. And they can be mad about it and whatever. But the trustee has to follow that trust document.
More basic trust questions. Because
Sure.
clearly right now, this is just the trust 101.
Yeah.
From what I do know is that an attorney usually is the one that sets it all up.
Yes.
But how does an attorney and how does a CPA kind of work together in any type of trust operation?
So setting it up is more the domain of the attorney, as you mentioned. So they're going to set up everything, help you get everything into the right space. I work with the attorneys more on the back end when someone does pass away. Then we work very closely together. But we do work I do working with them throughout the lifetime, I guess, just to at least keep a relationship with them and also be aware of any issues that could come up and work through those and maybe make some suggestions on how to structure things if I see that it could create problems after they pass.
Gotcha. No, that makes a lot of sense. Okay, another random question. Obviously,
Yeah.
it depends on the attorney that you use now and the type of
Yes.
trust, I would assume. But what is the ballpark price ranges that you could?
Yeah, it's hard to say. I've seen from the very cheapest, maybe $1,000 to I would say the average is probably a couple $1,000s, maybe 2,000 is probably a good rule of thumb. I mean, there's no set price, right? I mean, it could cost you 5,000. And it also depends on the complexity of your state. If you're going to need different types of, you say you have kids that are minors and you want to set up trusts. So it could get very complicated and cost a lot more than a couple $1,000s. If you have a standard husband and wife house and a decent amount of assets, I'd say probably expect somewhere in the neighborhood of about 2,000. I'm not an attorney. I don't know for sure, but that's what I've seen in the past. And it's definitely well worth it. Probate fees, like I said, can be about 5% of your gross estate. And so even if you only have $100,000 estate, that's pretty small. That's all your assets, everything put together. 5% of that is $5,000. That's going to go away when you pass away. You're right off the bat, you're saving $3,000 by paying 2,000 this estate plan or this trust.
That's the
So
interesting way to put it.
yeah, so it makes sense. So then think about $1,000,000 estate, right? That's $50,000 of probate fees you'd have to pay, and then you're talking big money. So if you live in San Jose and have a $2,000,000 house, you got $100,000 of fees there. And if you don't want to sell the house, then you got to come up with that $100,000 somewhere else. Even if it's $3,000, $4,000 for an estate, a trust, estate plan, trust, it really makes sense.
Is there anyone that you would say should not set one up or consider one?
If you don't have much in assets, if you don't have any beneficiaries,
At a certain point, obviously, and if you're listening to this podcast, especially now,
yeah,
thank you.
yes,
You can like it and subscribe for more. And clearly, Derek is just schooling me in all things trust. But okay, everyone is trying to, of course, level up their own personal finance and do the
sure.
best for their next of kin or whatever it may be. But yeah, and I'm sure that you have a network of maybe some trust attorneys or real estate attorneys. Like, so what type of attorney would we reach out to?
Yeah, you want to talk to an estate planning attorney.
Okay.
Yes, yeah. Which there are plenty of. Yeah, I've worked with a few here in the Bay Area, which, yeah, I refer my clients to.
Gotcha. And just from your perspective, when someone has a trust, pass away versus doesn't have a trust, and that's when you really get involved as a CPA. How
Yes.
much cleaner is that for not only for you, but also for the family?
Oh, much cleaner. Yeah, with the trust. Yeah, like I said, it's all spelled out in the trust, right? So there's no deviation. Things can happen in the meantime. But yeah, you basically follow whatever the trust says, take care of it, and you're done. And there's no time limit. You can keep the trust open as long as you need to settle the estate versus when you go to probate, you file an estate tax return. You do have to file a fiduciary tax return similar to a trust return. But there are some limitations on that. You have to close it out within a certain time or request extensions. And it's a lot more administrative hassle when you don't have that.
So a really morbid question. I'm assuming if majority of your interaction with trust happens when someone unfortunately passes away, I'm guessing that probably the next best time is if someone, say for example, is critically ill and is now beginning to do that estate planning. Is it helpful if they reach out to you and to an attorney then, or what do you think?
If they don't have anything in place, yes. The sooner the better. Even when you're young and don't think you need one, you probably still do need one. Even if you don't have any kids or things like that, if you talk to an attorney and really look at everything closely, I would say you most likely do need one. But talk to an attorney. It doesn't hurt to at least ask and find out because the overall savings, you may not see it yourself. You may be 6 feet underground, but the overall tax savings can be really significant.
Yeah. Yeah, I don't know. Going back again, the only time you ever think about is when someone unfortunately close to you passes away,
Yeah.
and
Yeah.
there's a
And then you don't
million
want to,
other things.
yeah, you don't want to think about money at that point. Yeah.
But that's also the thing that comes knocking the fastest too. Is there anything else you want to share about trust before we wrap it up today?
If you don't have one, get one.
So if you are looking for Derek's recommended attorney list, make sure to contact him. That's all linked down below. I learned a lot today, and that is definitely an action item for me this year. But Derek, thanks so much. I really appreciate you sharing all about trusts.
Sure.
All right. And if you enjoy this, make sure to share this with someone who would find value out of this, or can subscribe for more. And we'll see you all on the next one. Take care.